fan of surprises, but not surprise tax bills. And if you're holding on to the wrong types of fund, that can really be costing you at the end of the year. Where that comes into play is the difference, and really subtle difference, between mutual funds and ETFs, or exchange traded funds. On the surface, they're basically the same thing. So they're just a pooled account. So a fund company raised a bunch of money, pooled it all together, bought some securities, and then sold the shares to a bunch of shareholders. So it allows you to diversify. Rather than buying one share of Amazon, you get a tenth of a share in Amazon, tenth of a share in Johnson & Johnson, tenth of a share in Boeing. You're able to spread your money out a little bit without having to buy each individual company. So that's great. I'm a big fan of diversification. That's the same case for mutual funds or ETFs. Where they change is that mutual funds are considered open-ended funds. That means if I want to buy a share, they just make the fund a little bit bigger. And if I want to get out of that fund, then they just shrink it a little bit. Right? So expanding and contracting based on demand. Exchange-traded funds, on the other hand, always have the same number of shares there. So if I want to buy a share, I'll just go buy one from someone who's selling it, right? But they never make more shares there. If you're holding a qualified account, like a 401k, an IRA, an HSA, a 403b, something like that, it doesn't make a difference. If, however, you're holding a taxable account, like a taxable, a brokerage, a joint account, something like that, this expanding and contracting can really cost you a bunch of money, even if you're not the one selling it. So say, for example, that I exited the mutual fund, I took $10,000 out of the mutual fund. That fund company needs to go in and sell some securities to be able to do so. So they go in and they sell their share of Amazon. If that was at a profit, the profit at the end of the year gets pushed out as a capital gains distribution. And that capital gains distribution goes to every holder of the mutual fund. Versus an ETF doesn't have the expanding and contracting, means that you're really much more in control of your own tax situation. So as much as I love surprises, let's keep those surprises for fun times and keep it away from surprise tax bills at the end of the year.